Welcome to the Radio Revenue Podcast.
Hey, great to be here.
We are really thrilled to have you joining us for today's deep dive. Now, I know exactly what you might be thinking.
Oh yeah, looking at this stack of notes.
Right. I have this massive stack of notes in front of me detailing a Form 10K, specifically the 2025 annual report for Aon Plea.
Which is a heavy read.
It is. And unless you literally spend your weekends analyzing corporate filings, the phrase Form 10K probably sounds like a guaranteed cure for insomnia.
Yeah, 100 pages of dense financial jargon.
Exactly. Regulatory disclosures, accounting tables, the works. But stick with us here, because if you know how to read it, a document like this isn't just a dry financial summary.
Not at all.
It is actually a secret decoder ring for understanding the modern corporate world. It's a literal roadmap of global risk, high-stakes corporate strategy, and the very future of how we all work.
It really is. It serves as a perfect mirror for the global economy. I mean, Aon isn't just a company that participates in the market. They are the architects working behind the scenes.
Helping other massive corporations survive it.
Precisely. When you look closely at their 2025 filing, you get a front-row seat to the biggest anxieties and the smartest strategic maneuvers happening in boardrooms around the world today.
Okay, let's unpack this, starting with the sheer, staggering scale of Aon in 2025.
Yeah, the footprint is massive.
I'm just looking at the overview in your notes. We are talking about a company with roughly 60,000 employees operating in over 120 countries.
It's a truly global operation.
Can you walk us through the actual financials they reported to support an operation of that size?
Yeah, the numbers are nothing short of a juggernaut. For 2025, total revenue hit $17.18 billion.
Wow.
Right. That represents a 9% increase from the previous year, which is solid, steady growth for a legacy company. But the figure that really jumps off the page is their net income.
How high did it go?
It rocketed up 38% to $3.8 billion.
A 38% jump in net income in a single year. For a company that mature, that seems unusually high. How does a behemoth pivot that fast to generate that kind of cash? Was there some massive surge in demand for their daily services?
What's fascinating here is how they actually achieved that massive jump. Because it wasn't organic growth from selling more of their standard daily services.
Oh, it wasn't?
No. It was a result of a highly calculated, almost aggressive chess move involving a company called NFP.
Okay.
So Aon acquired NFP, which was a massive deal in the broker space. But rather than just absorbing the whole entity into their existing structure, they immediately executed a massive spinoff.
They spun it right back out.
Well, a big piece of it. In October of 2025, they turned around and sold a significant majority of NFP's wealth business.
Got it.
This included recognized brands like Wealthspire, Fiduciant, and Newport Private Wealth. They sold those pieces to Madison Dearborn Partners.
And what did that fetch?
$2.3 billion in cash.
So they buy a massive company, keep the parts they want, and immediately flip the rest to a private equity firm. I'm looking at the math here, and it looks like they netted a $1.2 billion pre-tax gain from that single transaction.
It's incredible.
But what is the strategic value in buying a company just to chop it up? Why not just keep the wealth management arm, considering it's clearly valuable enough to fetch over $2 billion?
It comes down to a very specific philosophy that Aon details throughout this 10K. They are relentlessly pursuing higher margin, capital-light professional services.
That's a capital light.
Yeah, wealth management is lucrative, sure, but it can be incredibly capital-intensive and subject to extreme market volatility. Aon wants predictable, recurring revenue streams that don't require them to tie up massive amounts of their own capital.
Well, that makes sense.
Right. So they bought NFP for its core insurance and benefits capabilities, recognized that the wealth management side didn't fit their long-term vision, and instantly monetized it.
It's essentially buying a massive, sprawling estate because you really want the main house, and then immediately flipping the guest houses to a developer to pay for the whole thing.
That is a perfect analogy.
Yeah.
It is a masterclass in strategic agility.
So if they are deliberately stripping away the heavy, capital-intensive parts of the business, what exactly is left? To translate some of the corporate jargon in this filing, Aon essentially operates on two massive pillars: risk capital and human capital.
And those two segments tell the entire story of what keeps modern CEOs awake at night.
Let's look at risk capital first. I was looking through the notes you shared, and this segment brought in an incredible $11.3 billion in 2025.
A huge chunk of their revenue.
And we should clarify for the listener, this isn't just selling basic commercial property insurance.
No, not at all.
They are advising companies on how to survive modern existential threats. We are talking about cyber attacks, catastrophic climate events, massive supply chain failure.
Really scary stuff.
Exactly. And one phrase that caught my eye in their new product launches was the data center lifecycle insurance program. What exactly are they doing there?
Well, think about the current explosion of artificial intelligence and cloud computing. The world is frantically building data centers to support these technologies.
Right. They are popping up everywhere.
But constructing and operating a multi-billion-dollar data center involves incredibly fragmented risks. You have the construction firm building the shell, the tech companies installing the servers, the utility companies providing massive amounts of power and cooling.
So many moving parts.
Exactly. If a delay in the cooling system installation causes a cascading failure that ruins the servers, who is liable?
I wouldn't even know where to start.
Most wouldn't. So Aon saw that fragmentation and created a single coordinated insurance solution that covers the project from the moment they break ground through its ongoing operations.
Oh, wow.
They are looking at the bleeding edge of technological infrastructure and figuring out how to financially protect it.
That makes a lot of sense. Instead of a tech giant trying to juggle 20 different insurance policies for one building, Aon acts as the single architect of their safety net.
Spot on.
And then you have the second pillar, human capital, which brought in $5.9 billion. This covers designing health benefits, voluntary consumer benefits, retirement consulting,
And helping massive multinational corporations navigate complex labor regulations.
which has to be a headache.
Designing a cohesive benefits package for a company that has employees in London, Singapore, and Chicago is a logistical nightmare.
Right.
Staying compliant with local tax laws, healthcare mandates, and retirement regulations in every single jurisdiction requires immense data and local expertise.
I want you, the listener, to think about your own workplace for a second. When you log into a portal to select your health insurance for the year, or when you check your company retirement plan,
Or even when your employer rolls out a new well-being initiative.
yes, chances are very high that a firm exactly like Aon is the invisible hand behind the scenes. They are structuring those benefits, negotiating with the healthcare providers, and keeping your employer compliant. They are woven into the very fabric of the modern workplace.
Their ubiquity is undeniable.
Yeah.
But, servicing that many global clients comes with a massive operational footprint.
Right.
And managing an organization of 60,000 people efficiently is incredibly difficult. Aon is constantly advising other companies on how to be lean and efficient, but looking at their own balance sheet, they've had to take a hard look at their own bloat.
Which brings us to a major theme in this 10K, the Accelerating Aon United program, or AAU for short.
Right, the AU.
Aon is essentially taking their own advice on how to run a leaner business. I see the estimated total costs of this AAU program were recently bumped up to $1.3 billion, with the vast majority being cash charges. That is a staggering amount of money to spend purely on internal restructuring.
If we connect this to the bigger picture, Aon is spending a tremendous amount of capital right now, specifically, to permanently lower their operating costs in the future.
You have to spend money to save money.
Exactly. That $1.3 billion is being deployed across three main areas: workforce optimization, streamlining their technology infrastructure, and significantly shrinking their real estate footprint.
Let's break those down. Shrinking the real estate footprint seems like a direct reaction to the post-pandemic world.
It is a deliberate alignment with a hybrid working strategy. When a company grows through acquisitions, like the NFP deal we just discussed, they inherit dozens of physical office spaces in cities where they might already have a presence.
Redundant offices.
Exactly. They don't need three massive traditional office spaces in downtown Chicago or London anymore. So they are taking the financial hit now to break or consolidate those leases.
And on the technology side,
It's a similar story. They are rationalizing applications, which is a polite way of saying they are cleaning up the digital clutter and redundant software licenses that accumulate when you absorb other firms.
it's the ultimate corporate spring cleaning. You spend $1.3 billion to take the trash out, but looking at the projections, the math definitely checks out.
It really does.
The filing notes that in 2025 alone, they realized an additional $160 million in annualized savings from these actions, and their ultimate goal is to hit $450 million in annual savings by the end of 2027.
It's a massive payoff.
You take the pain once to drive up your profit margins by nearly $500 million every single year moving forward.
Investors love that kind of discipline. It shows management is focused on long-term margin expansion. However, no matter how much you optimize your internal operations and clean up your balance sheet, you cannot control the outside world.
Very true.
And that brings us to the most revealing part of any 10K, the risk factors section.
Here's where it gets really interesting. There is a profound irony in reading the risk factors section of a company whose entire business model is based on managing risk for others.
Yeah, the ultimate risk managers.
When the ultimate risk managers themselves face existential threats, what does that actually look like?
It looks like a combination of incredibly complex legal battles, shifting global tax regulations, and the threat of technological obsolescence.
Let's start with the legal hurdles, because the liability a broker faces is massive. The 10K details a rather bizarre and high-profile controversy involving a third-party company called Vesttoo.
Yes, the Vesttoo scandal.
Aon was hit with lawsuits alleging that fraudulent letters of credit were arranged by Vesttoo employees in transactions where Aon provided brokerage services. Wait, before we go further into the lawsuit, what exactly is a letter of credit in this context?
Sure.
Explain it to me like I'm 5, and why would a company like Vesttoo need one?
Okay, imagine you are renting a very expensive apartment, and the landlord wants proof that you actually have the money to pay the rent for the entire year if things go south.
Okay, makes sense.
A letter of credit is essentially a document from a bank guaranteeing that the money is there and will be paid. In the complex world of insurance, counterparties use these letters to prove they have the capital to cover massive claims.
And Vesttoo's role?
Vesttoo was supposed to be providing legitimate backing for these deals. The lawsuits allege that the letters of credit Vesttoo provided were completely fabricated.
That sounds like something out of a financial thriller. Fake documents propping up massive insurance deals. But Aon was just the broker, right? They were just connecting the parties. Why are they on the hook?
Because in high-stakes finance, when a deal collapses due to fraud, everyone looks at the broker and asks, why didn't you catch this?
Ah, I see.
Clients claim that Aon failed in its duty to procure appropriate, legitimate letters of credit. As a result of the fallout, Aon actually had to take a $197 million charge for this back in 2023.
That is a massive penalty for someone else's alleged fraud.
It is, but the 2025 filing shows a silver lining. A $23 million reduction in that expense due to legal settlements and recoveries.
So they are fighting back.
They are actively fighting back and seeking recourse against the responsible third parties. Still, it highlights how vulnerable even a top-tier broker can be to third-party deception.
And reading further down, the legal exposure doesn't stop with fraud. There is a massive section dedicated to the 2016 Bolivia plane crash.
That's a tragic one.
I remember this tragedy in the news, but I don't understand how it ties back to Aon almost a decade later. The notes mention an aviation civil liability reinsurance policy. What is reinsurance, and how does Aon fit into this crash?
Reinsurance is simply insurance for insurance companies.
Okay.
If a local insurer writes a policy for an airline, a catastrophic crash could bankrupt that local insurer. So they buy their own policy from global markets to share that massive risk.
And Aon brokered that.
Exactly. Aon UK was the broker who placed that reinsurance policy for the Bolivian Airlines insurer.
Okay, so a tragedy occurs, the airline crashes. What happened with the policy?
The insurer denied coverage, claiming the airline breached the conditions of the policy. And when a policy doesn't pay out after a catastrophe, the lawsuits start flying.
Naturally.
And they aim at everyone involved, including the broker who structured the deal. Fast forward from 2016, and Aon finds itself tangled in a multi-jurisdictional legal nightmare.
Walk us through that timeline, because the geography alone is dizzying.
It started with claims filed in Bolivia. Then it escalated to a public civil action in Brazil, seeking up to $300 million plus moral damages.
That's huge.
It gets bigger. Then a group of 43 individuals attempted to sue Aon in Florida state court, seeking a staggering $844 million.
Nearly $1 billion in Florida over a crash in Bolivia on a policy placed in the UK.
The global legal system is incredibly tangled.
Yeah.
Aon actually had to go to the UK High Court to get an anti-suit injunction just to stop that Florida lawsuit from proceeding.
Wow.
But the legal maneuvering never stops. The 2025 filing notes that those same individuals have now filed a counterclaim back in the UK.
It just never ends.
This singular event perfectly illustrates the sheer scale of liability. When you broker policies for catastrophic risks, you are inherently in the crosshairs for decades if a disaster occurs and the safety net fails.
It's a sobering reminder of the stakes involved in their daily operations. But lawsuits aren't the only external threat. The 10K also dedicates significant space to global tax shakeups, specifically something called the OECD Pillar Two plan.
This represents a major structural shift in the global economy.
How so?
For decades, multinational corporations would incorporate in countries with highly favorable corporate tax rates. Aon, for instance, is incorporated in Ireland.
Very common practice.
Exactly. The Organization for Economic Cooperation and Development, or the OECD, decided to stop this global race to the bottom by proposing a 15% global minimum tax on large multinational corporations.
So no matter where you hide the money or where you incorporate, the world is putting a floor on your tax bill.
Precisely. The 10K notes that Ireland, the UK, and several other key countries have now enacted legislation consistent with this Pillar Two regime. So Aon's massive global revenues are now subject to this 15% minimum floor.
Which has to hurt the margins.
The filing is very transparent that as these rules continue to evolve and be interpreted differently by different countries, there remains significant uncertainty about how this will ultimately impact their global effective tax rate and their free cash flow.
So you've got third-party fraud, decade-long international lawsuits, and a changing global tax code. But there is one more risk factor they list that feels the most immediate, and that is the threat of technology.
Ah, yes.
The filing explicitly warns about the risk of disintermediation due to insurtech and artificial intelligence. I know disintermediation is just a fancy word for getting cut out of the deal, but how does AI actually threaten to do that to a firm like Aon?
Aon is the ultimate middleman. They use their proprietary data and human expertise to connect companies that need to offload risk with the capital markets willing to take on that risk.
Right.
But imagine a scenario where generative AI and advanced predictive analytics become so sophisticated and so widely available that a massive corporate client can just model their own hurricane or supply chain risks in-house.
So instead of paying Aon millions in consulting and brokerage fees to build a risk profile, a Fortune 500 company just feeds their own data into an AI model, figures out exactly how much capital they need to hold in reserve, and effectively self-insures.
Or they use lean, tech-driven insurtech startups that automate the brokerage process for a fraction of the cost.
Which would bypass Aon completely.
Aon acknowledges in this 10K that if they don't innovate faster than these emerging technologies, their core business model could be severely threatened. They have to invest heavily in their own AI and data analytics tools just to ensure they remain the smartest people in the room.
It is the classic innovator's dilemma. But speaking of the smartest people in the room, let's pivot to the human element. For all this talk of advanced AI and capital light strategies, Aon is still fundamentally a professional services firm.
Exactly. Their product isn't a widget.
Right. It's the expertise and relationships of their 60,000 employees. How are they managing their own internal human capital while advising the rest of the world?
This raises an important question, especially in today's highly competitive labor market. How does a giant, complex corporate entity retain top talent when every other financial firm is trying to poach them?
It's cutthroat out there.
It is. Aon includes some fascinating statistics regarding their culture and workforce makeup. Globally, their workforce is 56% women. And at the very top, their executive committee is 53% women.
That is definitely a standout statistic compared to traditional financial services averages. And looking at your notes, they also highlight a really unique approach to recruitment. They have this formalized apprenticeship program.
Yeah, this is really cool.
Most people assume you need an Ivy League degree to walk into a global financial firm.
They recognize that traditional hiring pipelines often miss incredible talent. They started this apprenticeship program in the UK in 2012 and brought it to the US in 2017.
How does it work?
It's a 2-year program designed specifically to bring in highly motivated individuals who might not have the traditional college degrees or professional backgrounds normally required for these roles. They provide intensive on-the-job training, classroom education, and mentorship.
And the scale of it is impressive. The notes say they've hired over 900 apprentices across the US and UK since its inception.
It's making a real impact.
That is 900 people getting a foot in the door of high finance without carrying massive student loan debt or needing a traditional pedigree. But here is the detail in the corporate governance section that absolutely blew my mind regarding how they treat their people.
Oh, the compensation tie-in.
Yes. We always hear companies say our people are our greatest asset, but it usually just sounds like empty corporate PR.
Right.
Aon actually puts their money where their mouth is when it comes to the executive suite. The 10K reveals that 20% of their executive discretionary incentive compensation is directly tied to people priorities.
That is a critical detail for understanding how the company is actually run day to day.
Yeah.
It means that 1/5 of a top executive's bonus isn't based on hitting a revenue target or a profit margin.
It's based on human factors.
Exactly. It is based on quantifiable performance in talent retention, employee engagement, and colleague well-being.
Think about how radically that changes management behavior. If an executive decides to burn out their team with 80-hour work weeks just to hit a quarterly financial target and top talent starts quitting, that executive gets hit directly in their own wallet.
It aligns the incentives perfectly.
So what does this all mean for you? It means that the modern corporate world is finally realizing that human capital isn't just a feel-good buzzword.
It is a hard, measurable financial metric.
When you have a firm whose entire competitive advantage relies on the intellectual property sitting inside their employees' heads, retaining that talent isn't just nice, it's a fiduciary duty. Tying executive bonuses to employee well-being is a trend I suspect we're going to see heavily replicated across the Fortune 500.
It is a very pragmatic approach to a very real business risk.
Yeah.
You cannot credibly advise the world's biggest companies on how to manage their human capital if your own workforce is churning and burning out.
Absolutely. So let's take a step back and look at the massive picture we've painted today. We took a deep dive into Aon's 2025 Form 10K, and what we found is a highly profitable $17 billion juggernaut that is ruthlessly optimizing its operations.
They're not standing still.
They are shedding heavy assets like the NFP Wealth division for massive cash gains, breaking office leases to shrink their real estate, and pouring over $1 billion into restructuring.
All of this to position themselves as the ultimate guide for a global economy that is becoming more dangerous and more complicated by the day.
They are navigating a landscape filled with alleged third-party fraud, global minimum taxes closing in on their margins, and the ever-present threat of disruptive technology.
All while trying to keep 60,000 employees engaged and protected. It is a delicate, incredibly lucrative balancing act.
Which leaves us with a final lingering question for you to ponder. We talked heavily about the threat of AI and insurtech. Aon thrives in a world full of risk and complexity. But as their own corporate clients get their hands on advanced generative AI and sophisticated modeling tools, allowing them to potentially self-insure or model their own complex risks in-house.
Will the traditional middleman broker eventually become obsolete?
Exactly. Or will the sheer chaotic complexity of global regulations, cyber threats, and climate events make Aon's deeply experienced human expertise more valuable than ever before? It's the ultimate race between emerging technology and human insight.
I guess we'll have to read next year's 10K to find out.
It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.